ultimately the question isn't where active management can work, it's where it has the greatest probability of improving participant outcomes after fees.
This is 401k Specialist Editor-in-Chief Brian Anderson, and this is the 401k Specialist Podcast. As market volatility, concentration risk, and evolving retirement income needs reshape the defined contribution landscape, plan sponsors are taking a fresh look at the role of active management in participant portfolios, and so is 401k Specialist in our latest deep dive on the topic. Is the decades-long debate between active and passive investing giving way to a more balanced approach? We'll dive right into that right after this brief message.
When it comes to retirement plans, we believe two things are true. Retirement is personal and accumulation is essential. That's why MFS Investment Management focuses on active, participant-first solutions backed by over a century of experience.
To talk about the changing role of active management in participant portfolios, I am happy to once again be joined by Jeri Savage, Retirement Lead Strategist at MFS Investment Management. We're going to talk about why active management is back in the conversation, where it can add the most value alongside passive strategies, and how fiduciaries should think about portfolio construction as retirement plans continue to evolve. Jeri, thanks for joining me today, and welcome back to the 401k Specialist Podcast.
It's great to be back. Thanks for having me back again.
All right, well, I'd like to begin by asking, why has the conversation about active management become a more timely issue right now? What broader market uncertainties and trends have emerged to steer participants and plan sponsors away from low-cost passive investing as a retirement strategy?
I think the conversation has become more timely because the market environment has fundamentally changed. So, for much of the last decade, low interest rates, low inflation, and a handful of mega cap growth stocks really helped drive market returns, creating a favorable backdrop for passive investing. But as we look ahead, we think there'll be a more different environment. So, one with higher and more volatile rates and inflation, greater geopolitical instability, supply chain shifts, energy transition costs, artificial intelligence disruption, and significant capital expenditure needs. Those forces create greater dispersion across sectors, industries, and individual companies. When market leadership broadens and economic outcomes become less predictable, security selection becomes that much more important. And that's where active management has the potential to add value. So we think about retirement outcomes through three forces: time, decision-making, and investments. Time is what allows compounding to work. Decision-making helps participants stay on track. And then investments determine how portfolios balance that opportunity and risk. In today's market environment, which is arguably more complex, all three matter more than they did a decade ago. So that being said, I don't think there's an active passive story here versus active versus passive story here. Most plan sponsors aren't abandoning passive investing, nor should they. Passive strategies continue to provide efficient, low-cost market exposure. They remain an important component of many DC plan lineups. But at the end of the day, participants are not retiring on fees. They're retiring on accumulated assets. So that should prompt fiduciaries to revisit all the tools available to help improve long-term participant outcomes. The discussion really shouldn't be whether active is inherently better than passive. It's about whether active management can play a more meaningful role in helping participants accumulate assets, manage risk, and stay invested over time.
That is definitely what our deep dive has been looking into. All right, now, how can active management complement passive investing in today's environment? And where do you believe it has the greatest potential to improve participant outcomes? And beyond that, do long-term predictions for market conditions make a stronger case for active management's costs and complexities?
Yeah, I think active management and passive investing, again, as I started to say, really shouldn't be viewed as competing philosophies. They're complementary tools that each play a role in helping participants pursue better retirement outcomes. So passive strategies can provide efficient, low-cost exposure to broad markets, which continues to be valuable in the DC space. Active management can play a different but equally important role, particularly in areas where market inefficiencies exist, where risk management matters, and where security selection has greater potential to influence outcomes. Retirement investing is not simply about tracking an index, it's about helping participants accumulate enough assets to fund retirement while managing that risk along the way. So active managers are able to evaluate company fundamentals, earnings quality, valuations, and competitive position rather than simply owning companies based on market capitalization. One of the strongest arguments for active management is that fundamentals matter. So, our research shows that stock returns are primarily driven by earnings, and positive earners and negative earners produce very different cumulative return outcomes. So, that's exactly the kind of dispersion active managers are positioned to evaluate, looking beyond those index weights to assess fundamentals, valuations, and risk. And then in today's environment, I think active management has the greatest potential to improve participant outcomes in a few specific areas. So, small cap equities, international and emerging markets, fixed income, even alternatives are all asset classes where research, security selection, and risk management may create meaningful differentiation. Active management can also play an important role in navigating market concentration risk, changing interest rate regimes, and evolving global market leadership dynamics that really passive strategies by design don't attempt to manage. To your question on long term market predictions, I do think this reinforces the importance of maintaining flexibility. So, higher rates, inflation pressure, greater market dispersion might create a larger opportunity set for active managers than what has existed during this previous era of abundant liquidity and narrow market leadership. So, that doesn't mean that active is always superior to passive. I think the key question for fiduciaries is whether strategy improves participant outcomes after fees. And if active management can improve outcomes net of fees in specific markets or asset classes, its costs and complexities are justified as part of the broader retirement strategy. And I think the goal here isn't necessarily choosing sides, it's assembling the best combination of tools to help participants accumulate the assets they need. And that's going to be a deeply personal decision to them.
Okay, now I'd like to ask about some of the key risks that are facing participants at the present. For example, what dangers do things like market concentration risk, inflation risk, and sequence of return risk pose? And how does active management help shift the risk in these?
I think four risks stand out today. The first is market concentration risk that you noted. I think a growing share of major equity indexes is tied to a small group of companies. So while those firms have driven recent performance, concentration increases vulnerability if market leadership changes. The second being inflation risk. Retirement can last decades and purchasing power matters. So inflation erodes that purchasing power and increases the amount participants must save to meet their retirement goals. The third is sequence of return risk, particularly for participants nearing retirement. I think experiencing large losses just before or shortly after retirement can significantly impact the longevity of retirement savings once withdrawals begin. Our survey data reinforces this. Plan sponsors rank diversification risk at 38% and downside market risk near retirement at 22% as the top risks their target date funds are trying to address. And then I think the fourth and often the most underestimated risk is behavioral risk. So, emotional decision making can significantly erode participant outcomes. Participants are really bad market timers and can make poor decisions. So, not to say that active management eliminates these risks, but it could help address through diversification, valuation discipline, and a focus on company fundamentals. By evaluating individual securities rather than accepting index exposures, active managers can potentially identify risks and opportunities that broad market indexes may overlook. And then by helping to build more resilient, diversified portfolios, active management can also support participants in staying invested through difficult markets. For retirement investors, that focus on risk management might be just as important as return generation.
Exactly. Okay. I'd like to shift gears a little bit here and talk about as defined contribution plans increasingly evolve from accumulation vehicles to retirement income solutions. Does that change how a fiduciary should be thinking about active management?
I'd actually push back a little bit on the premise of the question. We don't necessarily agree that defined contribution plans should evolve away from being accumulation vehicles. Accumulation is essential. It's the primary purpose of a retirement plan menu should still be to offer investment options that help participants accumulate assets and reach retirement with sufficient savings to fund a successful retirement. Without accumulation, right, there is no retirement income to generate. We've done a little bit of work on this in a hypothetical participant example from our research. Investment gains accounted for 5 times the value of total contributions and represented 79% of the ending account balance. So that's a powerful reminder that the investment decisions supporting accumulation are where retirement outcomes are largely determined. So when fiduciaries evaluate their investment lineups, the first question should be which investment options give participants the best opportunity to build long-term wealth? That's where active management continues to play an important role, helping participants navigate, as we've talked about, concentration risk, manage volatility, diversify effectively, pursue long-term returns, net of fees in areas where security selection and risk management matter most. But that said, as participants age, and if they stay in plan through retirement, fiduciaries do need to think more broadly about the menu. Retirement's personal. Participants have different savings levels. They have different income sources. They have different risk concerns. Supporting participants who remain in plan may require broadening the array of investment options and specifically considering income generating solutions that help retirees convert savings into sustainable income. So, from that context, we also believe that active management can be a useful tool, offering flexibility in managing risk, generating income, and adapting to changing market conditions. But the broader point here is that accumulation and income generation aren't competing objectives. To us, accumulation remains the foundation, and then income options should be viewed as an extension of the menu designed to help plan participants through their full retirement journey, not a replacement for the accumulation focus to help get them there in the first place.
All right. Makes perfect sense. Now, with so much discussion around bringing private markets into defined contribution plans, do you see active management becoming even more important in those investments if those investments do indeed become more common?
Yeah, I'll answer this in two parts because I think I have a somewhat different view than where the industry conversation has gone. First, on the likelihood of private markets becoming commonplace in DC plans, I'm not convinced that we're there yet. I think there's a lot of discussion, certainly some innovation happening around structures that could accommodate private markets in DC plans. But between operational complexity, valuation considerations, liquidity requirements, and really fiduciary comfort, I don't see private markets becoming a standard feature of most DC plan lineups in the near term. So, that said, the discussion itself is valuable because it highlights something really important. The same framework that fiduciaries would use or should be using to evaluate if private markets are appropriate in their plan is the framework that already supports the case for active management in DC plans today. So, the DOL's proposed investment selection rule reinforces this by emphasizing a multi factor evaluation framework. It includes performance, fees, liquidity, valuation, benchmarks, and complexity. Those are the 6 factors. Just as important, the fiduciary responsibility extends beyond selecting investments in the first place to monitoring them over time and maintaining a repeatable, well documented process. So, when fiduciaries evaluate investments through that lens, the conversation moves beyond just fees alone. It becomes a conversation about risk management, portfolio construction, participant outcomes, and long term return potential. So, that I think connects to a broader fiduciary theme playing out across the industry, understanding what you own and why. Indexes are constantly evolving. We've seen the recent Russell reconstitution as a good reminder that market leadership's never permanent. Participants might not realize how exposures and concentrations shift over time. Active managers look beyond these index weights and focus on whether underlying companies continue to justify their place in a portfolio based on fundamentals and long term prospects. So these 6 factors in the new framework, in my view, really support active management much more directly than they support the inclusion of private markets. So active management's designed to address exactly these considerations. And it's an established, well understood tool that fiduciaries already are comfortable with and can evaluate with confidence. So I don't necessarily expect private markets to become common in DC plans, at least in the near future. I think the current discussion around them is a really helpful reminder because it's highlighting how the fiduciary framework for evaluating investments naturally supports thoughtful consideration of active management. And it reinforces that active management is already an excellent option available today to help participants improve diversification, manage risk, better pursue retirement outcomes without waiting for structural innovations that may or may not materialize.
Well, I definitely agree that it's going to be quite a while before alternative investments make much of a dent in the 401k market. But now let's talk a little bit about bond strategies. While defined contribution plans have relied on them in the past, what has changed to shift the interest to fixed income, and what value does fixed income offer?
I think for many years, fixed income faced a pretty difficult environment because interest rates were historically low. Bonds have often served primarily as a source of diversification rather than meaningful income in defined contribution plans. Today, higher interest rates have created more attractive yields and have improved the long term return potential for many fixed income investments. As a result, investors are once again viewing bonds as both a source of income and as a risk management tool. And looking ahead, I think the potential backdrop of higher and more volatile interest rates and inflation, a very different environment from the past decade. So, fixed income continues to play its traditional role as a source of diversification and potential downside mitigation for DC plans, but it also provides income potential that may be especially valuable for participants approaching or entering retirement. I think that's really relevant, especially relevant when you consider how asset allocation and withdrawal choices interact in retirement. Different allocations and withdrawal rates can meaningfully affect the probability of sustaining retirement payouts over a 30-year horizon. So fixed income is going to be critical, a critical variable in that equation. I think many investors are rediscovering that fixed income is more than a defensive allocation, and as plans increasingly focus on retirement income and participant outcomes, it can play an increasingly important role in helping retirees balance growth, income, and risk management throughout retirement.
Now, for fiduciaries who are using a passive core of domestic large cap and efficient markets with active satellites in small cap, emerging markets, international equities, and alternatives, where can active management help create the most value?
I think many fiduciaries already employ this type of framework because they recognize that different markets present different opportunities. Active management has the opportunity to add value in less efficient markets, which typically have less to analyst coverage, greater information asymmetry, wider valuation differences. That's creating opportunities for skilled managers to identify mispriced securities. That said, we do believe active management can play a valuable role across the entire menu, not just in these satellite allocations, even in some areas often considered efficient, such as domestic large cap. Today's highly concentrated equity market may be expanding the opportunity set. When a relatively small number of companies drive a large portion of index returns, active managers have greater incentive to evaluate whether those valuations remain justified. At the same time, we understand that some fiduciaries prefer to limit active exposure to specific satellite categories where they feel the case for actives most compelling, and that's a reasonable approach as well. So in the typical DC menu structure, tier 1, the QDIA could be active, it could be passive, or it could be hybrid. In tier 2, the core menu commonly includes both active and passive building blocks. And then in tier 3, the brokerage window typically offers additional choice. That structure recognizes that different tiers and different asset classes within them call for different implementation approaches. We have survey data that reinforces this blended approach as well. 65% of plan sponsors report offering active investment options in their DC plan. 86% say they do so because it's a good practice to have a mix of active and passive options. And then 52% say that certain asset classes should be implemented through active management. So I think, to the conclusion here too is ultimately the question isn't where active management can work. It's where it has the greatest probability of improving participant outcomes after fees. That answer might be different by asset class, by market environment and manager skill, which is why fiduciaries should evaluate active and passive options as complementary tools rather than competing ideologies.
Right. Now, yeah, we've talked about this a lot already, but it does seem like the conversation has shifted from active versus passive to active and passive. Now, if the plan sponsor is reviewing its investment lineup today, where are the biggest opportunities for active management to complement and not replace passive strategies?
Yeah, I think that's exactly right. The future is increasingly about blending the strengths of both approaches rather than viewing them as competitors. So if a passive strategy provides efficient market exposure at a low cost, it can be an excellent solution for a particular asset class. If an active manager is offering a compelling approach to risk management, downside protection or security selection, that might be equally valuable elsewhere in the lineup. And participants are increasingly expecting solutions tailored to their individual circumstances rather than one size fits all approaches. They are telling us that they want some level of choice. Sponsors cite the value of blending approaches, using active where certain asset classes may warrant it, and focusing on long term participant outcomes net of fees. I think the biggest opportunity here is taking that participant centric approach. So rather than starting with a preference for active or passive, fiduciaries can start with the outcome they're trying to achieve and then determine which implementation tools are most appropriate. The most sophisticated retirement plans are likely to use both strategically, leveraging each where it can contribute the most value. In many ways, I think that's what plan sponsors are already telling us.
Okay. Well, you've covered a lot already here, but to close with, let's take a look into the future. So, say 5 years from now, what do you think the typical defined contribution investment lineup is going to look like? Are we going to still be debating active versus passive, or will that discussion have evolved into something entirely different by then?
5 years from now, I hope we'll spend much less time debating active versus passive. I think we will be spending more time discussing participant outcomes. I think we'll likely see continued growth in personalization, in advice, in retirement income solutions, and then potentially broader investment opportunities within certain plan structures. I think we've talked already about how the way we think about it is that retirement outcomes are driven by three things, right? Time, decision making, and investments. The industry spends considerable time debating investments and investment vehicles, but participant behavior is really one of the most important determinants of success. And again, to go back to that idea that emotional decision making during periods of market stress can have a lasting impact on long term outcomes. I think markets are always going to experience uncertainty. What matters is creating a disciplined framework that helps participants stay invested, that helps fiduciaries make consistent decisions, and helps portfolios balance opportunity with risk over decades. So, in that environment, active and passive investing will likely be viewed as complementary tools within just a broader toolkit. And then I guess I would end by saying, active management is not really a discussion about outperforming the benchmark. It's a discussion about whether it can help improve retirement outcomes for participants. And that's ultimately the standard against which every investment decision should be evaluated, not just active versus passive, but how every investment decision supports a participant's ability to retire and retire with confidence.
Excellent. All right. Well, you've certainly given us plenty to think about regarding the active and passive conversation. If our audience wants to further explore the topic, be sure to check out our 401k specialist deep dive on active management in uncertain markets, which you can find under the deep dive tag from the homepage on the 401k specialist website. We've got a terrific two-part article that includes more insights from Jeri and several other industry subject matter experts. Jeri Savage, thanks for joining us today on the 401k Specialist Podcast.
Thanks for having me, Brian.